Dustin Tibbetts, financial advisor here with Jazz Wealth Managers. This is our FinTips series where we cover quick tips to get right down to the point, let you get back to life, but hope you teach something to you so you learn along the way. Well, today I've got 4 retirement investing tips for those of you between your 30s and 50s, because December here in the stock market may have caused a little concern for you, and so we want to make sure you're on the right track. Tip number 1, let's get right to it. I want you to do contributions to your 401k, 457, whatever it may be that starts with a 4, up to the match, and only to the match. I've done lots of videos on this one. I'll probably beat this one to death before I'm done here. And so the point here is you do the contribution up to the match, then you move on. Now the reason for that is because, well, a lot of people focus on the investments and they forget to think about taxes in the future. A good financial advisor is going to make sure we've got all the bases covered. So if you put money into a 401k and the company matches up to a certain point, all of that is taxable. You go, well, Dustin, I have a Roth 401k, so I don't pay taxes on that. Fine, that's great, and stick with that. But the 401k match is all pre-tax. So you put in 5%, you're into the Roth 401k, all post-tax. Your company puts in 5%, well, that's all taxable, and we want to think about the tax consequence in the future, which is why we usually suggest you move on to the Roth IRA if that's a good fit for you, after you contribute up to the match. So tip number 1, you got to do the 401k up to the match. If you're getting 2, 3, 4, 5, 6%, Walmart's at 6% now, then you want to get that free money, but only up to the match, then move on to the Roth IRA if you can. I'm not saying that because I hope you call me, I hope you do, but I'm saying that because I want you to look out for your tax consequence as well. Don't just focus on the investments. A lot of people go, well, I'll just put an index fund in there and I'm good to go. All right, that might be your best choice in there, but can we do any better? So keep that in mind. All right, number 2, don't play defense. This is dangerous for me to actually say this, but be careful about playing too much defense in your portfolio. I get it. The markets are volatile right now. It's a bit of a back and forth game. It's probably going to stay that way too. So I want you to look at how long you have until retirement. Can you stay the course, or should you be defensive? A lot of people get too defensive too early. When you get defensive, you end up with lower returns. Nobody wants lower returns. So here's the question. Do you have a while until retirement? Well, Dustin, what is a while until retirement? Don't base it off the number of years you have until retirement. Base it off market stats. I'm actually going to give you a few stats here, a little impromptu thing here. So here's what we got. If you look at the stock market, you want to know what's the average decline from top to bottom in the stock market. Did you know that the average market decline is 196 days? I should say that a little differently. The average correction is 196 days. Do you have more than 196 days? You go, well, Dustin, that's from peak to bottom. I've lost money. So how long to recover? Well, actually, if you look at the worst case scenario, it was 929 days. That was when you go back to 2001 and 2003. What happened after that? The markets rallied and recovered within 4 years. So you had the decline. You got 2001 through 2003. Sorry for the really, really bad handwriting. And then that was 929 days. The markets took 4 years. They fully recovered. In another example, 2008 to 2009, some of you got a chance to live through that. It took 4 years to recover. Okay? So in one example, if you invested at the tip top right before the crash, you had to suffer through a 7-year window before you got all your money back. That's if you bought at the absolute high. Markets crashed 929 days. After 929 days, we marked a low. We saw the rally that took 4 years to come back. You got all your money back and you were ready to go. So worst case scenario, 7 years. That's not my opinion. That's the actual worst case scenario. The 2008 scenario, you had to wait a total of 5 years. Do you have more than that until retirement? That means that long it took to suffer the downturn and recover. Those are the worst on record. Use that data. Use it so that you know, wow, I've got 15 years left to retirement. I can stay the course. I can be somewhat aggressive. Maybe I can be really aggressive. That's up for you and your advisor to decide. But know that you have time because of market statistics, not because of what some silly formula tells you. You know, financial advisors have been taught you take 100 minus the person's age, and that's how you come up with their stock to bond ratio. Really? Like, that's how simple they're trying to make it for everybody. Let's do what you need to do, and let's understand what we're doing based on stats there. Okay, so that's number 2. Don't play too defensive too early. You can disagree with me. Obviously, everybody is individual and will have their own circumstances, but consider it. Use the stats. All right, number 3, please don't use an IRA or a Roth to buy a house. Please? Now, here's the thing. Can you use an IRA or a Roth IRA to put a down payment on a house? You certainly can. It's called a qualified distribution, where you can take up to $10,000, use it for a down payment on a house, to build a brand new house, whatever you want. You can take the $10,000 out. If you're a first-time home buyer, that's a big one there. You can use it as a down payment. The definition of first-time home buyer doesn't actually mean your first-time home, by the way, so there's a little fudging there. But anyways, here's why I don't want you to do that. Number 1, there's a chance you don't do the withdrawal correctly and you owe the IRS on all $10,000. You got to pay the penalty, you might have to pay taxes and everything. So careful, right? That's a problem we don't want to have there, especially around tax time if you didn't do a qualified withdrawal. But the real reason here is when you do it this way, and a lot of people try to do it with me like this. They go, Dustin, I'm going to have some retirement and some for the house, all inside my IRA. Well, naturally, retirement is further down the road, so we can be more aggressive. The house is a shorter term investment goal, and so therefore we can't be as aggressive, right? So you end up splitting your retirement account and you go, but this is great because when I pluck the money out for my first time home purchase, all that interest that I made or the compounding that happened, well, that'll just keep going. But in reality, it was invested more conservatively. Wouldn't you have been better off with no risk and putting it in a high interest savings account, or having a completely separate individual account? Maybe that's a tough one there. To keep it going that way with either no risk or very little risk, keep the retirement all moving full speed ahead. So I know it's a weird argument to make and it may not fit everybody there, but think about it that way. You have an account growing very little and you pluck out the money to buy the house with a little bit there. You somehow need to know, okay, let me change that to be aggressive, and it really probably didn't benefit you that much anyway, so be careful on that one. And number 4, I beat this one to death, know your number. Don't know how much money you need to have for retirement. Know how much income you will need in retirement. By the way, I was the first person to go about doing this. We have lots of videos where I would say how much to make $50,000 a year when you retire, how much to save to make $80,000, and you can disagree or agree with the variables that we used on those. I tried to do a lot so you get those variables. But we've done this now for so long, not because of us, but Congress is actually putting a bill through, if they could get anything done, that's actually going to force 401k companies to post that for you. Meaning they're not going to show you, hey, if you retire today, you'll have $1 million. They have to show you how much an income you will have when you get to retirement. I love it, right? That's the way it should be done. It's a tighter number. We do it for all of our customers here that want that done for them so that they know, with all things factored in, what's the magic number? How much do I need to save? Okay, well, that's it. Number 1, I want you to do the 401k up to the match. Please watch some of our videos on that one. Number 2, don't play defense too early. I know when the markets get scary, you want to, and that happens. Number 3, if you can, don't use an IRA to buy a house. If you happen to have an IRA and then you decide to buy a house, different story, but don't set out on that path going down that road. Just too many things that can go wrong. And number 4, know your number, right? Simple as that. Well, if I helped you in some way, or if you just enjoyed this and you thought, hey, that was cool, never seen something like that before, hit the subscribe button or check us out at jazzwealth.com. We work with investors of all sizes. We are SEC fiduciary financial advisors, and we build and manage our own funds so we can actually prove that we don't sell anything but ourselves. Thank you.